All right, it looks like we're ready to get started. I'd like to thank you all for attending and welcome you to Trucking Freight Futures kickoff here in New York City. Sponsored by K-Ratio, who are in the room, and in partnership with Nodal Exchange and DAT. And of course, I'm Mike Vincent with FreightWaves. I'm EVP. And if I might tell you a little bit about myself, I have 32 years, well, almost 32 years in logistics, everything from LTL to truckload, ocean freight, air freight, warehousing, distribution, etc. Touched everything except railroad. In my past lives, I have managed $150 million and up purchase transportation spends. And aside from figuring out the budget year to year and looking at previous cyclical data and looking into the crystal ball of what we thought was going to happen across the future and wetting our finger and sticking it up in the air and taking a solid, educated guess at what the budgets were going to be, hitting those budgets throughout the year and by the end of the year was a very difficult chore. And the reason that is as freight starts to move and capacity starts to tighten, the market is heated up. Plenty of freight moving, the capacity starts to tighten, costs go up, blows me out of my purchase transportation expense. Freight starts to loosen a little bit or dry up a little bit, and capacity starts to loosen. We get a little bits of windfalls where our purchase transportation costs go down and we get back in line in budget. And hopefully by the end of the year, those windfalls have outweighed those points where the pricing has gone up and blown us out of our budget, and we can all clap our hands and pop champagne corks and hopefully we've had a good year. But the rest of the year is kind of like that commercial with the monkeys turning it up and down. Yay this week, bad this week, and so on and so forth, trying to figure out how we're going to manage those budgets. Very, very difficult. Saw many of my colleagues, friends, lose their jobs over this exact problem. So when I was asked to join FreightWaves and I heard what Craig Fuller and the team were doing, I jumped at that chance. And FreightWaves is a gathering of very strong and deep tribal knowledge in the industry. Some of the brightest minds, C-level executives with years and years of experience that have experienced the exact same things that I had. All brought together with a common goal to bring transparency to the market, to the industry, transportation market, and to provide tools to de-risk those fluctuations and volatilities in the pricing. What I'd like to do is start out talking about market sizes and opportunity. Here we have three very large and liquid exchanges that have been started within the last few decades. You've got crude oil at $421 billion, natural gas at $138 billion, electricity futures $390 billion. Very large, massive markets, lots of volatility in the prices, lots of need and demand for a de-risking tool. Crude oil, 1983, had its what we call OPEC moment. OPEC started, decided the nations were going to control the oil flow of oil and make their money off the flow of oil. Created a ripple effect in demand and need and demand for a tool to de-risk against those volatile prices. I'd like to show you another market that does not have these tools yet. The U.S. trucking market is enormous. $726+ billion is the North American U.S. truck or the U.S. truck market. 30% larger than petcoke and refined petroleum, larger than agricultural and electric combined, 2x plus over electric power generation. 84% of all the commodities that are traded move on a truck. 84%. That means people like Procter & Gamble, AB InBev, Unilever, ConAgra, the Home Depot, those sorts that are trading and hedging against these commodities are also involved in the trucking market. The truck market is every bit, if not more, integral to these industries and our economy. Trucking is also the largest mode of transportation in the United States. It is not rail, it's trucking, and it is growing faster than the US GDP. Freight costs are cited as being the largest cost of goods sold, even larger than energy, in many of the sectors of the economy, and stated to be one of the #1 costs and problems associated with cost and budget maintenance within 40% of the 500, I believe, is the figure. I don't have that in front of me. It's also 8% of the US GDP. The market, the truckload market, transportation market is highly volatile as well. You can see from the lows in 2014 to the highs in 2018, 136% growth in spot prices, 136% growth. More importantly, all these peaks and valleys along the way, the volatility of this pricing occurs almost weekly. 60+% swings up and down throughout those years, and you'll notice after the high, another massive swing down. Highly, highly, highly volatile. What are some of the things that causes this volatility in the transportation industry? Well, let's see. Virtually everything that happens affects the transportation industry. From government regulation or the belief in a tweet that tariffs are going to occur causes influx of containers into the ports, backup of trucks, full warehouses, capacity being sucked up, restrictions on capacities in certain markets, wide fluctuations in pricing and availability of capacity on certain lanes, and it ripples throughout the country. Weather is the same way. A weather event, a hurricane event, FEMA comes in, grabs all the capacity. The capacity is sucked dry in specific areas that then have a ripple effect across the country and in other markets, causing wide fluctuations in pricing and the inability to move goods. When it's over, capacity is dumped, and now you have this massive swing back down as people are trying to fill their capacity. Obviously, manufacturing, the economy, driver availability, diesel prices, etc., cause volatility in the trucking market. When you talk about the economy and manufacturing, it's not only macro, but it's micro as well, specific regions. It can be very regionalized in its effect on the market. When you have a large swing in Chicago in pricing or capacity of that of truckload capacity, and hence these changes or swings in pricing, it affects Minneapolis, it can affect St. Louis, it can affect Detroit as capacity comes in to try and fill those voids, lowering prices into Chicago, raising prices out of Chicago on specific lanes. The point is, it's not just the overall economy, it can be very regionalized and into microeconomics. So, I've showed you the oil market, the natural gas market, the electricity market. All massive markets, all integral to industry and our economy, all highly volatile. Strong demand, strong need for tools, financial instruments to de-risk the fluctuations in that price. Truckload, I hope I've painted you a picture. Truckload is a far larger market. It is every bit as integral to industry and the economy as those other markets are. In fact, 84% of them travel on truck. It is highly volatile. The volatility within weeks, within a week, I should say, within months, across years, cyclical changes, government regulations, et cetera. Weather, virtually just about anything that can happen in the economy affects volatility in the pricing in spot market. Strong need for de-risking. So I told you my own story and the stories of others. If you talk to the shipping, transportation folks. So a quick story. A colleague of mine at FreightWaves and I were happened to be meeting at a very large retailer, worldwide retailer actually, on their earnings report day. The whole place was celebrating. Everybody was celebrating. They were dressed up in specific garb to celebrate this day. Everybody in the place was celebrating. People were in from all over the country. It took us literally 45 minutes to find a parking space to get in for our meetings, because we were there in a room much like this with their entire transportation team hunkered down, trying to show them, well, not trying, but explaining freight futures and other tools that we have to help them be celebrating too, because they got their ass kicked throughout the year because they were not celebrating. They missed their budget wildly. And you can see from that chart, there it is right here. These wide swings right here in their costs. They have no tool to mitigate against that risk. They have no way to take that P&L line that says, if my costs, or in the case of a carrier, if my revenues per mile are at this, and I can keep them within this range, I can affect positively my OR and therefore my shareholders, my board members, et cetera, et cetera. They have no tools. Futures is the tool. So why now? Trucking's been around a long time. It's been volatile forever. It's been integral to our economy forever. Ubiquity of telematics. We've always had, well, we haven't always, but we've had devices for a long time that can tell you the geolocation of assets, capacity. The proliferation of telephones gives us real-time information on the specific drivers and activities and pricings and accepts of loads and rejects of loads. Cloud versus on-premise computing. From the largest players, the C.H. Robinsons, the Home Depots, the Unilevers, to the small guys, cloud-based computing, all these people are uploading data, real-time data, that is then discoverable and actionable. Through the cloud computing, interconnected systems, the mobile devices, as I described before. Market conditions, the ELD mandate, so it's kind of the industry's OPEC moment, if you will. The ELD, if you're not familiar, so electronic logging devices, drivers had paper logs. And they could utilize 1, 2, 3 in their cab, whatever they needed in order to be efficient, meaning make money and keep freight moving. ELDs, electronic logging devices, that was gone. That was gone. No more cheating, if you will. Lowered productivity and efficiency. Trucks moving, they used to move an entire move in a day, 1 move a day, are now taking 1.2 days to move, 1.4 days to move. There's less capacity, less efficiency. Labor shortages, obviously. The Amazon impact. The Amazon impact. So now we got to have things in an hour. Have to have them in tomorrow, right? Used to be, hey, it's going to be delivered in 5 to 8 days. It came in 6. You're like, yes. Now it's an hour, it comes in an hour and 15 minutes, and you're standing by the door waiting for it, right? Less efficient way to ship for the transportation industry. Trucks got to move. They have to move. The demand to get it there on time is more and more. You can't wait for a day or 2 days or a couple hours. In the case of LTL, can turn into days late. But you can't, the point is you can't hold that truck to fill it and utilize that capacity as much as you possibly can, driving up prices, lowering efficiencies, eating up capacity. Capacity crunches. And I was right. 40% of the S&P companies have stated that freight and transportation costs are the most substantial risks. So who are the natural players exposed to the freight market volatility? So you have trucking companies. These are the ones, the assets that are moving the goods, right? These companies are naturally long. When prices go up, they've got the graph this way and everybody's cheering. Yeah, we're making money per mile. When capacity frees up, freight market goes down, prices go down, they lose their shirts because they're selling their capacity for a price. When capacity is eaten up and the freight market is driving like crazy, like we saw in the chart in 2018 and several other spikes throughout that 4-year gap, during those spikes, these guys were making money on the spot market. Conversely, you have the shippers. Shippers are the manufacturers. Kellogg's, Procter & Gamble, Nestle, AB InBev, etc. Those shippers. They're naturally short. So when there's plenty of capacity and the spot market prices is driving down, they're beautiful. When it goes up and the prices go up, they're not so beautiful. They have no way of hedging against those ebbs and flows. Talk to people. I have friends at Pepsi that lost their jobs. I have friends at other companies that lost their jobs this past year because they had no way to mitigate that risk. They have an excuse at the end of the year. It's an accurate excuse, still an excuse. Still got to manage that bottom line, and they don't have it. They need it. I've been evangelizing it for a little over 2 years now. And the question is, can I trade them now? When are you going to list? When are you going to list? When are you going to list? When is this going to list? They want it now. 3PLs or the freight brokers. So what these guys are doing is they're going to an AB InBev, they're going to a Procter & Gamble, et cetera, and they're saying, okay, I'll haul your freight at $1.50 a mile for these specific lanes or in these specific regions for X amount of volume for a year. And then they have to go out and source the capacity. They can be playing both sides, short and long, but they're really short. They're looking for prices to go down on that capacity so that on that $1.50, they can make 10 cents, 15 cents, 20 cents a mile. When it goes up to $1.60, $1.65, they're losing. So what do you need for a good market? A large market, a volatile market. Trucking is the largest market, extremely volatile. It is integral to industry and our economy, no doubt about it. You need a benchmark index, DAT. Consider them the Platts of spot market prices, discovery. 700 plus sources, 256 million transactions, electronic transactions executed, $60 billion worth of transactions, which is over half of the spot market. That's what they're based against, is the index from DAT, our partners at DAT. An exchange and clearing, Nodal, leader in power markets. It was a good fit when we met with Nodal because power and trucking is very, very similar, right? They're both finite, they're both perishable. Trucking moves on a grid like power moves on a grid, and they're highly subject to regional fluctuations and volatility. Nodal's been with us since the beginning, building this market as well. You need a strong partnership with a leader in an exchange to help you build this market, and they've been with us step by step building this market. And then of course ourselves, FreightWaves is the reason why. The tribal knowledge, the years of experience from C-level executives like myself, from past lives, that would have killed to have this when we were managing those huge transportation spends. The goal is to bring it to them, and that's what we hope to do. Approximately 40 billion miles in spot freight annually, U.S. Contracts are 1,000-mile contracts, 40 million contracts to be traded is the size of that. I'm going to turn it over to you, Danny.
Yep.
If you'll excuse me while we change this mic real quick.
You need it? Goes for the.
You need it for the one.
So I'm with Nodal Exchange. If you don't know much about Nodal Exchange, we were launched in 2009 by some market participants in the North American power markets. So we were born out of the need to really create new and innovative risk tools for the power markets. Over the subsequent years, we were able to grow the business. We're currently about 33% of the open interest. We're the second largest power exchange in North America, so we're competing with companies like CME and ICE. We manage about $19 billion of open interest in the North American power markets. And so, as we grew our exchange, two things happened. In 2015, we launched a clearinghouse. So with every exchange, there must be an associated clearinghouse that manages the risk. It interfaces with the banks that support the business. When we launched, we had a partner, LCH. In 2015, we launched our own clearinghouse, and now it's a vertically integrated market. And so that really allowed us to grow our business and also brought in some attention from some folks in Europe. So Deutsche Börse bought us in 2017. And so now we're owned by EEX Group based out of Europe. We're part of the larger Deutsche Börse family, so that includes exchanges like Eurex. And so if you don't know much about exchanges and how futures are launched, so every futures contract in the US must go through a regulated exchange. And so that piece is Nodal Exchange. In order to participate on a regulated exchange, you must become a member of the exchange in our scenario, the way that we're structured. And then you also must have a bank that guarantees your business. And so the division of duties amongst the exchange and the clearinghouse, the exchange is really bringing people together to transact via execution methods and then providing ancillary services, whether it's data or price discovery out the future curves. And then you have the clearinghouse, which manages risk, which understands what is the margin needed to post a futures contract, what is the current price of the future curve, how do we use that information to market our participants on a daily basis, and how do we protect our market participants from each other. Centrally cleared products, that's one of the key drivers. What we're doing when we have a cleared exchange is that we're providing more liquidity to a product because it allows people, and rather than dealing with direct credit, so where historically you would trade with counterparty A versus directly with counterparty B, you guys are managing each other's credit and understanding what those companies' wherewithal is. When you have a cleared market, what you rely upon is the clearing members to do a lot of that due diligence for you. And so actually all the due diligence for you. And so what it means is that you no longer have to be as concerned with who is on the other side of the trade because the clearinghouse and the associated members are doing that due diligence for you. And so what that looks like is you become a member of the exchange and then you have an associated clearing account that allows you to participate on the exchange. These FCMs, the ones that are currently supporting Nodal Exchange, what they're doing is they're guaranteeing your performance. So in the event that a counterparty would not be able to meet their obligations, the FCM steps in and is able to take on that responsibility and make sure that the rest of the market is safeguarded from that particular participant not being able to satisfy their requirements. And so these folks here are these banks are the banks that are currently supporting our market. As you look to trade and futures on Nodal Exchange, the first part is really getting a clearing relationship with one of these banks. And so what you will need to do is, it helps if you have an existing banking relationship, or you may already have a clearing account with one of these banks. Contact them and let them know that you're interested in trading freight futures. To the extent that you don't have a relationship with one of these banks, then we can give you contact details for the folks there, and then we can start the relationship and start the conversations with getting an account. But being participants in the exchange, it is, again, being a member of the exchange and then having a clearing account with one of the associated clearing members. How do people transact on the exchange? So there's really three methods to transact. So there's trading on a live trading venue. Nodal Exchange has T7 matching engine, which is a Deutsche Börse technology. It's used by Eurex and EEX Group, and now Nodal Exchange. We launched that in November of 2018. It was one of the biggest things we did since the acquisition, which is launching that technology. And that allows for us to bring people into we call central limit order book. That is the back-end technology. The front-end technology that allows people to access the order book is what we call a trading platform. Nodal Exchange partnered with CQG, which is a household name in the futures industry, to have a live online trading system that people can easily access. And so that went live also in November of 2018. It's where trucking freight futures from an electronic perspective will trade. If anyone is, there are participants in the market who choose to write directly to the matching engine. They have the capability with the APIs that we have built in, but that's a conversation that participant would have with their clearing member, and it's based on the level of sophistication that they want to participate in the market. Some firms want to have that low latency and be able to react to orders that are being placed in the market, and so they may set up an algorithmic way of trading, and they'll use the API for executing or putting those orders on. In addition, you have nodal block trades. Those come in two forms. Those are directly negotiated deals between two counterparties, so where counterparty A and counterparty B, they know each other. They prefer not to deal direct, and they prefer to clear it to mitigate the counterparty risk. And so those can come directly to Nodal Exchange via a block. And then additionally, there's voice brokers you'll go out and you'll say, I want to sell 100 lots of the national average. And then they'll go out to their network and they'll talk and they'll find you buyers. And so they're providing a service in that they're not only providing liquidity to their resources, but it also, in many cases, they'll let you know where the market's trading. If you want to do a transaction, they can give you insight into how deep a certain, within their liquidity pool, how deep a certain market is or where it's currently being priced. And then FreightWaves Sonar is the data platform that you'll see a little bit later. You can directly access Nodal's live trading platform through Sonar. So if you're on Sonar, we'll be feeding data into Sonar that allows you to see what's happening in the market. But to the extent that you want to transact, there will be a way to launch the trading platform directly from Sonar, and then you can access trading that way as well. I think, Tom, are you going to take over trucking freight futures contracts? And we'll be around later for questions on membership and give you the right contact details.
Can we interrupt you with questions as you go? So you have those 12 FCMs that are probably Nodal.
Not capped at 12. And so we have other FCMs that have expressed interest. And so we expect a handful more to join in the next 12 to 18 months. But it is a membership process. And so any interested FCM would come to us and then go through the membership criteria. Any other questions while we pause?
Hi, good afternoon. My name is Tom Allen. I'm with FreightWaves, and I'm going to run you through quickly the contract specs and some highlights around it. So this is the map of the lanes that we have identified for the trucking freight futures contracts. We work very closely with the Nodal Exchange and DAT in terms of determining the most liquid lanes where trucking freight futures should be listed. These lanes consist of lanes where there's heavy volume of loads being moved on a daily basis. And the basis for selecting these lanes was really correlation. Not only the amount of freight that moves along each one of these lanes, but the correlation of these lanes to the rest of the US. So that's a very important point. So in working with DAT and Nodal, we've identified 7 lanes that span across 6 different cities. So on the West Coast, we've identified the lanes Seattle to LA, LA back to Seattle. In the South, we've got the lanes LA to Dallas, Dallas to LA. And then in the East, we've got the triangle, Chicago to Atlanta, Atlanta to Philadelphia, Philadelphia to Chicago. And from those 7 lanes, we've also identified baskets, regional baskets. So in the West, we've got the West Corridor, which is the round trip between LA and Seattle. The South is the round trip between LA and Dallas, and the East is the triangle. So this is the network of freight futures contracts that will be listed and launched on March 29th. A bit about the specs. I talked about the 11 contracts that we intend to list on the 29th. The contract type, these are monthly contracts. They are cash settled contracts, which means that there will be no physical truck involved in the transaction. They are settled off the index produced by DAT. The settlement is a daily settlement, and the positions that are open are marked to market by the Nodal Exchange on a daily basis. There'll actually be intraday mark to market as well for the payment and collect of intraday margin. These are dry van freight futures. They're line haul rate based, meaning that there's no fuel or other charges involved. So it is the price that is paid for a truck to actually pick up a load and to move the load along the various routes. The contract size is 1,000 miles, so that's the standard. 1,000 miles is the contract size. The pricing is dollars and cents per miles. And the forward curve will go out 16 months, meaning that you will be able to trade trucking freight futures out forward 16 months. Yes.
In terms of the lot size, so is it like ton miles? Is it 1 truck per 1,000 miles? If I have 500 trucks running,
it's just I mean, it is a portfolio of 1,000 miles. There's no truck involved.
So okay, so if we get into like if you're a shipper, how many contracts you need to hold to cover, XYZ volume of freight?
Yeah, so what you would do, I mean, you've got the 1,000-mile contract. You would look at your portfolio of miles that you would need to ship goods and services, the areas that you're looking to ship those goods and services, around, and identify whether it be the regional basket, a specific set of lanes that you would use to hedge your position.
Can I ask a quick follow-up question? The previous slide that showed, if you don't mind, so the analytics behind that, do you publish the methodology around, say, that study? Is that public, or how transparent can you get to?
We are yes. So we have DAT here. We are in the process of producing a public document which talks about the methodology employed for how the data is collected, what it represents. So the answer to your question is yes.
And what percent-ish? I'm guessing there was some statistical modeling to try and.
So yeah.
So like perfect route. That's like the benchmark route.
So based on the analysis and studies that we did, roughly 23% of all freight actually move along these lanes that were selected, with a correlation of about 84% to nationally. So that was those are the metrics that we used in terms of selecting the lanes.
And then DAT gets like flat sort of a real-time price for that specific route, and that's how it will tick.
So what they do, they collect the data electronically. The data that is collected is based on loads that are actually picked up by a truck and driven away. So it's not indicative pricing, and it's not, bids or offers. These are actual loads that are picked up on that day and driven away by a truck.
The transacted freight rate.
That is correct, and they are spot rates only. They're not contracted rates.
Spot rate.
Spot rates only.
Okay,
Okay?
cool, thank you.
Mhm.
Can I ask a quick question? I just wonder if if contract isn't in this, and most of the shippers you mentioned are overwhelmingly contract shippers. We talked about volume. What volume do you actually anticipate the spot market you're looking at would be?
So if we look, we looked at the volume of, of contract and spot, and, we are estimating that annually about 40 billion miles will go to spot, on a national average, which equates to 40 million futures contracts. So that's the metric that we're using.
Yeah, even those large shippers that are heavily contracted, and I don't know if they can hear me on that live stream, but even those shippers that are heavily contracted, they have a significant percentage that is not contracted. They're irregular routes, right? They contract the regular routes, and then they have a significant percentage, it varies from shipper to shipper, that are left to go to the spot market. Also, as the volatility of capacity constraints occurs, those shippers will, what we call, have a waterfall effect or fall out of those routing guides and have to go to the spot market as well. So there's an additional percentage there as well. So that helps.
And finally, these are cash settled contracts. No truck will ever show up, so people don't have to worry about trucks.
Tom, you have questions?
Yeah, as a follow-up to sort of one of the analytical questions earlier, will DAT or the exchange or whoever make 5 years of history, daily history available to participants at no charge, so shippers can see how well this correlates with their actual expenses? Speculators can try to figure out what drives the industry, how to get, see if this is something you want to participate in, similar to WTI or HEO or whatever else it might be. How much information about history, so you can test that indice to see if it actually works for you, will be made available?
So we have about a little over 5 years worth of what I would call very clean history data on all of these lanes, and we can make this available to anybody that wants to do correlational studies.
At a cost or free?
Free.
And beyond that, if there's a desire for it, right, our commercial product, which is the basis for our commercial product, which is the basis for, it's kind of the subset is what we're representing here with these 7 lanes. We've got much finer granularity in terms of equipment types, hazmat ratings, and other things. And so that's all available through DAT. So there's an extensive amount of information available to obviously inform you guys to the best outcomes.
And if I could, just one more follow on that. Sorry, we're like hogging the questions, but so I get that on the periodicity with which it settles, but in theory, with the transactions, it could tick in real time, like sort of a Brent futures price on your screen. Do you envision this ticking? With what periodicity will the market tick that you're trying to capture the price on these benchmark routes? Like, is it a daily published number, weekly, monthly, or like, will I be able to open my Bloomberg terminal and go to the right sort of ticker for this and watch it kind of second by second as it's moving?
So there are 2 components, I think, to that question. One is the index data that's published by DAT. It's a daily price. Okay. Where you'd see tick-by-tick data, that would be through the trading that takes place in the futures market.
Right. Okay. So
Okay.
daily.
So yes.
Yeah. Okay. Thanks.
So I'm sorry, so a follow-up on that then. So daily, referring to yesterday?
It's published. No, the rate that is published at 5 o'clock today would be for those loads that were picked up today.
5 days ago.
5 days ago.
5 days.
Yes, I'm sorry.
Yeah. And the reason is that we need to make sure that there's sufficient sample size so that we can get an accurate representation. And so, because we don't get immediate, we're mostly integrated. We're mostly integrated with the TMS. This is where we get our source data from. And so, just to ensure that we've got enough to come through to be statistically relevant, and then not have one specific contributor that is overweighting that particular lane.
Any other questions?
The question is, the monthly contract, is that the average of the daily settlements, or is it just the average on the final date?
The final settlement is the average of the daily settlements posted by DAT
Yeah, for that month.
for that month.
Yeah.
You'll probably need to see liquidity develop and see how well these corridors are actually traded. But I can see in the future you might have Chicago-Dallas or LA-Chicago, right? You might expand these to other lanes?
That is, yes. I mean, these are the ones we're going with initially. We wanted to get launched. We did our research on the lanes, and these are the ones that we are going to go to market with on March 29th.
This is an unfair question, but you don't know yet. Is your hunch that it'll form a forward curve that behaves like other commodities that will move between contango and backwardation in the shape of the curve? Basically, like the laws of physics as they apply to other futures markets and exchange-traded paper contracts will make sense here too. Have you guys thought that?
I anticipate there'll be a forward curve. The shape of the curve, I don't know.
But that it'll move and kind of look like other markets.
That's correct.
Yeah, cool.
Yeah, in terms of the curve, you already mentioned how far it's going out. As you talk about product maturation, you think about other locations, you think about other terms, you think about extending it out further. And so those things will come in time as the market matures. But yeah, on Nodal Exchange, every day, twice daily, you'll have a full futures curve published on every single lane that's offered.
16 months forward, just to write about the next time we have a presidential election. Tariffs and tweets.
So just a little bit more on DAT, and these questions were great. I mean, it touched upon the methodology and the things that we need to take into consideration in terms of building the settlement mechanism for these contracts. But again, to emphasize what Michael had talked about in regards to why DAT, why are they a partner? I mean, they are the largest price assessor within the trucking industry. Their data and trends are derived by $256 million freight matches, and they have just a huge database of transactions. So, that's the why behind DAT in terms of selecting them as the methodology. They are the benchmark. They are, for people who are familiar with energy, they are the Platts of trucking for this market. And now what I want to do is just give, yes.
What will the when it opens on the 29th, what will the trading hours be?
The trading hours are Nodal's trading hours. They'll be 9 a.m. to 5 p.m. Eastern time. Now what I'd like to do is just give you an illustrative, scenario about how these contracts, could trade electronically. This is a simulator. It's not live trading. This is not the Nodal CQG instance, but I just wanted to give you a flavor, and a use case for how these contracts will be traded on March 29th. So I'm going to open up the simulated trader now. So what you're seeing on this screen is, a mock-up of a user interface that a trader could see. And so on the top component, what you see here is account information. This account information is what is set up by the FCM, the clearing member. So it gives you your account balances. It gives you a look into your P&L and relative financial market. In the middle portion is your instruments, where you would be able to select instruments for trading. And in this case, what we've done in this simulator is set up a simulation for the regional markets. So basically the three regionals and the national average. On the bottom are orders and position information. So if you're a trader, you're interested in what positions you have open, what orders you have in the market. And to the left would be your actual market information in terms of order book and the like. So in this scenario, what I want to do is quickly just show you a user experience around trading. So in this case, I'm going to be a shipper, and I'm looking at my portfolio of miles. And I'm going to want to, I'm looking at my portfolio of miles. I know as a shipper I have about 10,000 miles that could go to spot of freight. And so, you know, in that scenario, I am actually short capacity. If I'm happy with the price where it is today, and I think I am, you know, I'm going to look to hedge that. And so what I'm going to do is put a hedge on for February. So I'm going to go down and click on the February instrument. Click on the February instrument for the West US van lanes. It'll bring up a depth of market in my order book. If I wanted to place an order, and because I'm short capacity, it means I'm going to want to buy futures contracts, and I'm going to want to buy 10,000 miles worth of futures contracts, which would be 10 contracts equivalent. So if I was to go to the market and want to buy, I would put in an order for 10 lots. I would buy those 10 lots, and you would see my position at the bottom update. I'm now long February, the West Coast lane. I've got my fill up here, and now I've actually locked in terms of my transaction, the beginning part of my hedge. A couple weeks later, you know, as I am moving my freight, I'll begin to unwind my position. And so 2 weeks later, I decide that, you know, I'm satisfied, my freight is moving, you know, I've accomplished what I wanted to accomplish in terms of price. I'm going to unwind my hedge by simply going back into the market. I'm going to place an order, and in this case, I'm going to sell 10,000 miles worth of the February West Coast van contract. And so I sell the contract, I get my fill, and my position updates, and I'm now flat in terms of that. So this is just a scenario to show that, you know, the freight futures are going to be tradable. They're going to be tradable electronically, and just a really quick use case as to how they could be used. So from here, I'm going to go back into the presentation. And I believe I am going to turn it over to Kyle from K&O.
Thank you. Hello, everyone. My name is Kyle Littner. I'm a principal at a firm called K-Ratio. For those of you not familiar with us, we are an NFA member firm. We are a CFTC registered CTA. If you're not familiar with the acronyms, that simply means that we are legally allowed to give you advice, consent of trades, and complete risk management services. Some of what I'd like to get into, I think we might have touched on earlier. I apologize if it's redundant, but to me, it's important to revisit. I think it's worthwhile. I know it got brought up earlier, but in 2018, 40% of S&P 500 companies cited transportation as the main reason they missed earnings. 40% of 500 companies said that transportation costs were the biggest reason. I had to repeat that because that is so important to what we're trying to do here. I don't know why somebody wouldn't get involved in something like this. This exists in every other market. and every other industry that is even smaller than what we're looking at, $700+ billion. We're trying to get to something to eliminate the risk that's out there. If you miss your earnings, yes, that stinks. You've lost a little bit of money, but it doesn't just resonate now, it goes forward. If you look at the valuation of your company, I'm sorry, is there a question, Mike?
Oh, yeah, I just have a question. So regarding that 40%, are there any more specifics on that, into like any more breakdowns?
I don't know if I want to start naming names. If you'd like to get together later, I'll be around.
Companies, but like reasons why. Like,
Yes, freight cost was higher.
Yeah.
Higher than what they planned or perceived the rates to be. And that's kind of what we're getting at here. Like Mike mentioned earlier, companies forecast their budgets with their transportation spend, but you're just throwing darts. There wasn't anything solid to look at. So even those that aren't going to participate on the futures hedge, at bare minimum, you're now getting a forecasted rate for 16 months out of what the market perceives rates to be. This is a tool to make your estimates not only more accurate, but effectively lock them in. And what I meant by locking it in was really trying to get around the whole aspect of missing those earnings, because it doesn't just stick with right now. You know, your stock will be devalued if you miss earnings, and if you're a private company, now your valuation's lower. I don't know what multiple your company operates in, but you can multiply that out times whatever the missed earnings may be. Now you're looking at possibly 2 to 3 years forward missed because you didn't apply the tools that we're trying to present here today. Along those lines, for the shipper, this is the easiest way for everyone to think about it. We're trying to make a variable cost into the fixed cost. We're looking to remove volatility in the marketplace. I've stressed how important this is to put a number to it. It's been estimated that 5 to 14% of a shipping company's expenses are transportation related. So anywhere between 5 to 14% is subject to unhedged volatility. Now, this is the national average for rates on 2018. 2018, we saw rates increase 30%. We're talking about 5 to 14% subject to a 30% rate increase, but what's held in this is swings of up to 62%. So the peaks and valleys that Mike mentioned earlier, you have your rates high in July, you have your rates low in October, you have your rates plummeting now. Volatility is all over the place, and this is just a tool to eliminate that. Makes your shareholders happy, makes your board happy, makes your bottom line happy. For the carrier, same thing, except we're not talking about cost now, we're talking about revenue. If you're a truck company, you'd like to know what you're getting for your trucks. Outside of just knowing what you're getting for your trucks, you'd like to lock in what you're getting for your trucks. It's the same thing. Everybody has their estimates and their guidance, but this is something that effectively allows you to lock in those rates. Some people will say that the carriers do have contracts. That's what their revenue expectations will be based on, but a lot of carriers aren't contract only, majority of which operate in the spot market. Nobody knows what the spot market's going to be. Even what the market's showing you 7 months out is just what we think the market's going to be. I don't know where it's going to be in 7 months, and neither do you. This just allows you to lock that in. For the carrier, same pricing map, 1 year out national rates. In red, July. Currently in green, now. If I would have asked anybody in July, where do you think rates are going to be now in February, not one person would have told you here. Every single person said rates are going higher, we need to do something about it. Well, everyone's wrong. This is personally where I think it gets interesting. A lot of people ask me where I think 3PLs or brokerages, however you want to term it, operates in this space. Some people don't think they have a role going forward, but to me, I think they stand the most to gain and also the most to lose. Any 3PL who can take this new tool, apply it to their business, will be more competitive going forward. You're effectively a middleman in this. There's the shipper, there's the carrier, and you're operating in between. A 3PL would need to be long and short the market at the same time. We want the operational revenue stabilized. We'd like to limit the carrier expenses. Yes, you are going to be short up at the bottom and you are going to be long at the top. Now, sometimes people here say, well, I can't be long and I can't be short. I would have nothing on or I would be delta neutral. That's where a little bit of the play comes into this. There's some art to this science. First, the most obvious thing would be the carrier aspect of it. 3PLs like when rates are higher. Whatever your margins may be, you're taking a bigger cut out of a bigger number. The short position for the 3PL allows them to lock in their expected revenues going forward. The cool side to this to me is the long aspect of it. So this is LA to Dallas. This is not the national average. If you're a 3PL, you've now protected your revenues with your short hedge on the national average. You can take it to a micro level. Whatever your RFP or your contract business is done, let's say it's LA to Dallas in this instance. This allows you to insulate the risks associated with finding capacity covered when rates go higher. Almost every single 3PL books contracted business as if it was freight. So you might be operating in the contract side in the industry. When it comes to making the transactions, you're doing it all on spot. If you're doing it naked, you're doing it unhedged. The 3PL has to be both long and short at the same time. If they are not, they're not going to be competitive. This exists now, this exists going forward. When we get to 2020 and RFP season comes around again, the people that will win the bids are the ones that will adopt this, because if you're not pricing low enough to win the awarded lanes, you're obviously pricing in the risk premium on your own lanes, and you're not putting it out in the market to take. These are just complete hedges. This is not something that's a way to make money. This is just a way to push the risk to somebody else. If you'd like to get into some of these things on a more in-depth level, I will be here all night, or you can head to kratio.com. I think with that, I'm heading it over to Mike.
Do you have a chart that overlays that west corridor with the national averages and maybe with the other southern and eastern corridors as well?
I can provide you with any chart you would like to see. Here, no. I do not have it on this computer. This is not mine. I apologize.
Another time.
Are you alluding to the...
Well, your chart there, when you mentioned that impact there of July through December, or, sorry, correct me.
National or LA to Dallas?
Well, this one you said was LA, right?
This is national.
This was national. But the other gentleman's curve earlier showed more peaks and troughs, and that he was probably national average.
My national average is 2018. This is year over year, January to January. I believe the national average you saw was 5 years back, 2014 to 19. Okay. Broader term, same risk.
That's all right. Thanks.
Sure. Anyone else? Yes?
I've just got a question about that. So there's 7 main corridors.
Yeah.
And I think I overheard that, you know, they correlate roughly to 80% of all lanes across the U.S.
84, I think was the number thrown out.
84%. So I don't know if you're the right person to ask, but what's the methodology behind those corridors?
Methodology, I'm not the person to ask for it. We have our own personal opinions on how you can apply your lanes to what's given. There's obviously some correlations in there. I know, let's say we have Chicago to Atlanta. That's very highly correlated to Des Moines to Nashville. I think personally, at a minimum, you could take the deadhead or the rate per mile for the distance to get to the 2 points. But without speaking in concrete numbers, I could say that you will be able to find very high correlations with low variance between what's traded and what's offered. Yes?
Yeah, early off in the presentation, there was a chart that showed diesel fuel prices as one of the drivers of the trucking costs that this indice represents. But then later, I thought I heard that diesel.
These are ex-fuel. These contracts will be strictly excluding fuel dry van trucks, 53-foot dry van,
so
line haul only.
When a carrier sets a rate, to say, you know, to go from LA to Seattle, does he factor in what he's asking the cost of diesel?
I'm going to pass that one to Mike. I have my own opinions on it, but let's just do it legally.
You're not paying the driver. I mean, you might have a surcharge.
That's exactly right. So there's a fuel surcharge that agreement between the shipper and the carrier.
On that terrible EIA.
Correct.
But that's a surcharge. But when you set the actual rate,
No.
So carriers don't contemplate fuel costs at all?
No, it's in the surcharge tables that are agreed to with the different contracts.
Then why was fuel diesel costs on that chart? Not, one of the earlier charts listed the.
Yeah, it was all the examples that can disrupt the trucking market, and diesel is one of those that can do that. When you get specific to the pricing index that we're talking about here, no, the diesel price really does not affect that. You're absolutely right.
So, in the Philly to Chicago run, Pennsylvania raises tolls on the PA Turnpike. for
It's
trucks.
not in the pricing index.
So that, if I knew that was coming, I couldn't speculate on that index.
It wouldn't have effect on the price on these
So the tolls would be something charged.
separately. Those are accessorial charges that are put into the contract, but it's not the rate per mile that's in the contract. Absolutely right.
And what we try to do is really try to break it down to its kind of the core transportation piece of it, right? So we removed, multiple pickups, multiple drop-offs, we removed hazmat ratings, other things. So you're really just getting at the core, what's the line haul rate between, Atlanta and Philly.
What obligation do shippers or carriers have to give the information to DAT?
We have contracts with a number of shippers, carriers, 3PLs that are providing us the underlying rate detail. They do for a commercial product called RateView. We take, again, that subset of that, which becomes the indexes here. Through those contracts, they have timeliness and completeness that they provide to us. And it's the network effect of the more that they provide, the better insight that they get back as part of a recipient of the tool. And so, we look for changes in what's being submitted to be indication of they're not maybe supplying the entire population of their loads. But in terms of like a specific audit, we don't have an audit in place that allows us to go back and make sure that every load is captured in every single one. But one of the things that make us feel very comfortable about that is we're directly integrated into their TMSs. And so what we're getting is an automated feed straight out of what they're using for their logistics management.
So if I could relatedly, none of this is meant to be criticism, I think this is brilliant stuff and super cool, and congratulations, by the way, for how far you guys have gotten. I'm wondering if there was ever a debate about delinking price from cost and publishing like a real-time cost. So you can get kind of real-time fuel costs, toll charges, the truck, whatever, and then trying to take kind of the pricing piece out and then linking the derivative freight contract to kind of a real-time ticket cost, and then let the market make itself, even on the fiscal side, around this new cost index, as opposed to more sort of antiquated reasons that exist for historical sort of tables and stuff.
Yeah, but I think what we've seen over the years is that that cost, it goes down to a driver's willingness to accept a load at a price, right? So there's an underlying supply demand for that driver. And part of the reason why the spot market exists is because there's fluctuation in and out of contract as everybody's trying to arbitrage, right? So you're going to have, if you can get a few pennies better deal on the spot market than through your contract rates, you might try and go that route. So it's difficult to kind of deconstruct that in the way that you're talking about because there's still that decision point of a driver accepting a load.
It's going back, I'm sorry, maybe it's too granular, but just on the accessorials, you have me a little bit confused. Currently, most accessorials in the market we're talking about are shipper-derived. Shipper-derived fuel surcharge, et cetera, then it gets negotiated. So we have a line haul, what's essentially a line haul contract here, and we still have to go negotiate the rest. Why would that change?
It wouldn't, I don't think that it would change. I guess I don't understand the question.
How do you, just legally,
the price, the
how do you have
miles,
a contract when you have an open term?
you have,
There's no meeting of the minds until that final term is taken into account and agreed to by the parties. So if they have to negotiate whatever it is, tolls, fuel surcharges, port fees, how do you take that into account and still have this automatic clearing?
I don't want to speak out of turn, but I believe a lot of what you're alluding to is extrinsic in nature. So we're just trading what's intrinsically valued here, which is the line haul. Any of the accessorials are somewhat baked in. That's what makes the cost what it is. Outside of that, the charges are not tradable. Those are just fixed, or in your case, float. But the greatest component of all the trucked rates are this line haul.
Yeah, but my point was, that question was asked, which was, is this an all-in rate? And the answer was no.
Correct.
So how do you do that? So how do I know that I'm arranging for 10,000 miles of capacity until I've agreed to every term with the party who's going to do it?
You're simply mitigating the risk in the largest component in that cost. Line haul would be, for the sake of the exercise, let's say 90% of your cost. The other 10% is your accessorials, that's up to you.
So if I couldn't come to that agreement with accessorials, and typically you do, I mean, this is all theoretical. If I couldn't come to that, I would just cancel the contract,
Not on the exchange.
okay? But that's the point. We can talk offline. But
Sure.
It's an interesting issue.
Anything else? Well, thank you all for coming. It's been a pleasure. We were really excited to have this kickoff here today. We're going to have a little networking reception after this. I believe it's right around the corner. We can trade cards, et cetera. And we will be following up with each of you and sending you out the information that was presented here today and contacts for further information. So thank you very much for coming.